Well, from JK Tyre, which has been reacting quite positively to numbers, to Bata India, which has had a bit of a rough quarter. Stock's still down about 5%. After the company reported pretty mixed set of numbers for Q2. A lot of the major parameters are actually down as the company has been going through the GST transition. Well, we have Gunjan Shah, Managing Director and CEO at Bata India, to walk us through some of these trends. Gunjan, thank you so much for joining in. So for the benefit of our viewers, I'm just running through the numbers again. Your top line's down by about 4%, and profits have also been slightly sluggish, if I could say. Margin is at about 18% versus almost 21% same period last year. So just tell us, is the bulk of the GST pain over? What is happening with the inventory and what is happening with your pricing strategy? Because that threshold where the lower GST comes in is at 2,500 rupees. So, will there be a propensity, say if you had, a product at about, 2,800, will there be a tendency to now reprice it in such a way so that it gets the benefit of the lower GST? So therefore, how should we expect this transition to play out over Q3 and Q4?
Sure. Hey, hi to your viewers. Good morning and belated Happy Diwali. It's been a quarter that's got impacted by the transition, but we were well behind it on the 22nd of September when the effect went into place. It did obviously impact trade and consumer sentiments and therefore deferment of purchases. But I think post that there has been a I think a good uptick and recovery, in which we hopefully will pan out over the next couple of quarters. From a pricing point of view, Surabhi, what we have done is we have, as was also suggested and indicated by the government, we have passed on the entire benefit. The portfolio that has got, obviously will get repriced because of this is almost about 80%, and that has already been done. So that's already in market, right? So we will basically want to ensure that we stay with the principles of passing on the price benefit to the consumers. In addition to that, because we wanted to manage and lubricate the transition and therefore clear out inventories, that did have an impact on our gross margins temporarily till about 22nd. We are hopeful that all of that should now recoup back as things stabilize post the 22nd.
So some numbers here will really help. I mean, even if let's not look at Q2 alone, let's look at first half. Mangalam has helped us with the numbers there as well. Revenue is up just 2.2%, and your first half margins are at 19.7%, just south of 20%. So let's talk full year now. By the time this year ends, all this would have normalized, right? So full year, what's the expectation for top line and margins?
Yeah. So we are hopeful, obviously, of this recovery will sustain going forward. And in fact, actually, in my view, I think GST is a structural piece and therefore should have a structural demand recovery. In addition to that, there are a few other initiatives that we have done. I think one of the largest ones has been zero-based merchandising and the refreshing of our stores. So we have already hit about 250. We plan to hit 400 by the next quarter and 800 by middle of next year. So I think that refresh is giving us significant bounce back in terms of like for like in the stores that we have done. So that plus, I think some of the collection that we have launched, I think the Victoria Ballerina collection has been a big success. We expanded to almost a full store network as well as with much larger volume and variety, and that should give us an uptick. So I think a combination of the GST structural impact, some of the store refresh that we are doing, as well as the collections and the stories that we plan to present to consumers should augur well for us going forward. From a margin perspective,
Mr. Shah, sorry, just to come in, could you, for both revenue and you characterize the environment, would you be able to put some numbers to it? H2, what kind of growth?
Nigel, but what I do foresee, obviously, is a significant amount of bounce back coming through with, obviously, the GST transition pain under the belt.
Prashant here, sir. But you don't think there is, you won't be able to sort of put some numbers on it?
Yeah,
your assessment.
I will refrain from giving you a forecast, but we are pretty positive post the 22nd from the response.
No, but can you sustain a 20% margin with the repricing? Like you just said, 80% of the portfolios had to be repriced. So can you still do 20% margin?
No, so we've done it. It's basically impacted, about 6% for pricing of products which are below 1,000, as well as about 11% for the ones that are above. And that is margin neutral. So that doesn't impact margins at all. I think this impact that we saw last quarter was largely because of the transition should bounce back.
All right. Hi, Mr. Shah. This is Nigel here. Good to speak to you. Premium products as a percentage of your total sales mix, how much is it?
It's about 30%. And obviously, even last quarter, despite the transition pains, premium has done well, which is hush puppies, power, floats, etc. So that continues to have much better traction. But we are hopeful the lower end also will see much better traction now with the tax arbitrage coming down.
The ideal sales mix be if premium is at around 30% right now?
Yeah.
What would the ideal mix be? Where do you see that number headed?
So it'll keep on creeping up as premiumization continues in the economy and consumers as well as in our portfolio. So my sense is that this will keep adding about 2-3 percentage points every year. So it should reach in the next about couple of years, I think about 40% plus.
Can you tell us about your e-commerce sales plan as well? What is it at? Where do you see it headed? And the measures that you are taking in?
Yeah, so e-commerce has been our fastest growing business, just like most other players, right? Over the last 5 years now. Now it is low double-digit contributions to us. We've also been very conscious of making sure it is accretive in terms of profitability. So it's not been just sell at the cost of anything. So we've been very conscious on that front, and I think we are expanding going forward. I don't see a reason why it should not be our fastest growing channel going forward. From low double-digit contribution in the next 2 or 3 years, we should be at about 20%, north of 20% contribution. So it will be a fastest growing and will drive growth for us.
Mr. Shah, just to press, without asking you to put numbers to it, but revenue growth has been low single digits. Do you see, I think margins are below pre-COVID levels. Could you give us some sense of how this is likely to shape up? Some analysts are cutting your expectations from where you are for FY26, FY27, etc. So how would you look at it?
Yeah, no, thanks, Prashant. So I think the way we are looking at it is that margins per se, I think, are a combination of both the leverage on top line as well as in terms of cost structures. I think in terms of cost structures, I feel very comfortable in the space that we are with the kind of structural corrections that we have done, including the one-time VRS that we have done even last quarter. So we've been more than happy to make sure that we invest in those cost structure corrections that we are working for the long term. So I think there we are pretty comfortable. Once the leverage on the top line comes through, the margin should bounce back.
All right. And there'll be some annual savings as well because of that VRS, right? You want to quantify it very quickly?
Absolutely. They give us paybacks within less than 3 years. So there will be, savings recurring for us perennially.
All right. The shoelaces seem to be tied and you're set for a bigger sprint in the time ahead. We wish you well, Mr. Shah. Look forward to chatting up with you. Past quarter may be a little bit softish, but you're guiding for better times ahead. So we'll track you to some of these numbers. Have a good day ahead.